Good morning. Grab your coffee, pull up a chair, and let's get into it. You've been hearing for months now that the worst is behind us. The Fed stopped hiking, inflation is cooling, and the markets are celebrating. But here's the deal. There's a shadow hanging over the global economy that most people are completely ignoring. It's not a cliff we're falling off. It's a wall we're about to hit, and it's a big one. We're talking about the maturity wall. Between now and the end of 2026, roughly $10.5 trillion in global corporate debt is set to expire. Let that number land? $10.5 trillion. That's a 125% jump in refinancing volume compared to just a few years ago. And here's why that matters to you. Even if you've never bought a corporate bond in your life, think back to 2020 and 21. The world was awash in free money. Companies were borrowing billions at 2, maybe 3% interest. It was the era of the great lock-in, but those loans weren't forever. They were 5-year notes. And guess what? The 5 years are up. Starting right now, that cheap pandemic-era debt has to be repaid or more likely rolled over. But the world has changed. That debt that cost 2% to carry is now being refinanced at 8%, or 9, or 10. It's what economists are calling the Great Refinance, and it's hitting the system like a localized earthquake. We're moving from an era of free money to an era of coupon shock, and honestly, this is the part I find wild. Everyone is acting like this is a gradual slope. It's not. It's a vertical wall, and we're driving straight toward it at 60 miles an hour. Now, some people will tell you everything's fine. Jan Hatzius over at Goldman Sachs argues that corporate balance sheets are resilient and that this wall is more like a manageable hill. Janet Yellen thinks our high GDP growth will let us outrun the debt. But look at the math. The math stops working when your interest costs triple overnight. And when the math stops working, the smart money starts moving. So the question isn't whether the wall exists. The question is, what happens to your savings when the bill for our free money era finally comes due? Okay, let's talk about the real problem. Let's break down how this coupon shock actually works. Because it's not just a line on a spreadsheet. It's a massive drain on the world's actual cash flow. Imagine you're a homeowner, you've got a comfortable mortgage, you're making your payments, and you've even got enough left over for vacations and a new car every few years. Then suddenly, your bank calls, your interest rate just tripled. Your monthly payment goes from $2,000 to $6,000. You're not bankrupt yet, you've still got your job, but suddenly there's zero money left for groceries, zero money for repairs, and definitely no money for that new car. You enter what we call operational austerity. You stop spending on anything that isn't the mortgage. That is exactly what's happening to corporate America right now. This is the mechanism that's quietly killing growth. Check this out. The interest coverage ratio for the S&P 500, excluding those massive tech giants sitting on piles of cash, has plummeted by 45%. That means for every dollar a company earns, almost half as much is going straight to interest compared to 3 years ago. We're talking about $1.1 trillion in annual interest payments for the US federal government alone. To put that in perspective, that's more than our entire defense budget. We are spending more on the ghost of past debt than we are on protecting the country. And for corporations, the effective coupon rate on high-yield debt has jumped to 8.45%. That's more than double where it was in 2021. So here's the consequence. Companies aren't hiring. They aren't building new factories. They aren't researching the next big thing. They're just treading water. They're cutting R&D and pausing expansion just to keep the lights on and the lenders happy. It's a slow, quiet stagnation. It's the sound of a decade of growth being sacrificed to pay for the mistakes of the past. I know, sounds dramatic, but look at the data. When companies prioritize debt service over growth, wages stagnate. When wages stagnate, consumer spending drops. And when spending drops, well, you see where this is going. If the world's biggest companies are bleeding cash just to pay interest, who is sitting on the other side of that check, collecting the billions? Because that's where the story takes a very dark turn. So here's the part nobody's talking about. While traditional banks are retreating, terrified of the maturity wall, a new group of players has stepped into the light. We call them the Shadow Titans. Think Apollo, Blackstone, HPS. These aren't your neighborhood banks. This is the $1.7 trillion private credit market, and it's growing faster than almost any other sector in finance. Here's how the game is played. A company hits the wall. They can't get a loan from a regular bank because the risk is too high. So the Shadow Titans step in. They offer rescue financing. Sounds helpful, right? Well, not so fast. These loans often come with predatory interest rates, 12, 15, even 18%. It's not a rescue, it's a takeover in disguise. They are effectively cannibalizing corporate America from the inside out. They're taking the profits that used to go to shareholders, the money that used to go to employee bonuses, and they're moving it into offshore vaults and private equity funds. They've got $450 billion in dry powder just waiting for the next wave of defaults. They are waiting for the wall to break companies so they can buy the pieces for pennies on the dollar. This isn't just a financial shift, it's a massive transfer of power from public markets to private, unregulated entity. And this web is interconnected. When a commercial real estate loan in Chicago expires, it might be a shadow lender in London or a pension fund in Tokyo that's holding the bag. The coupon shock is global. We're seeing a 68% increase in distress volume in the commercial real estate sector alone. That's nearly $1 trillion in property debt hitting the wall this year. If you think your local mall or office park looks empty now, just wait until the interest payments triple. This feels like a modern heist, doesn't it? A $10 trillion transfer from the productive economy to the lending class? But here's the thing, history has a funny way of repeating itself. And if we zoom out for a second, we might realize we've seen this exact movie before, but this time, the ending might be different. Let's take a trip back in time. The year is 1873. The world is coming off a massive boom fueled by cheap debt and the rapid expansion of the railroads. Everyone thought the growth would never end. But then, the debt came due. The Panic of 1873 triggered what historians call the Long Depression. It was a period of painful liquidation where the system had to reset by letting the bad debt burn off. Now, fast forward to today. The similarity between 1873 and 2026 is staggering about 88% by some metrics. We've got the same overexpansion, the same reliance on free capital, and the same maturity wall. But there's one massive difference. Back then, the system reset through liquidation. Today, we've been trained to expect the Federal Reserve to swoop in and save us with lower rates and more printed money. We expect a soft landing. But here's the part that should make you sweat. The Fed put might be dead. In 1873, the solution was painful but honest. Today, we have structural inflation driven by deglobalization and energy shifts. If the Fed prints more money to save the companies hitting the wall, inflation spikes again. If they don't print money, the companies default. They are trapped. The monetary easing exit is blocked. We are seeing the return of the term premium. For the first time in decades, investors are demanding higher compensation just to hold long-term debt. The 10-year Treasury real yield has jumped to 2.1%. That might sound low, but it's a 310% increase from the negative rates we saw just a few years ago. The historical mirror is telling us that this isn't a temporary glitch. It's a structural reset of how wealth is valued. Ray Dalio over at Bridgewater warns that we are in the late cycle of a long-term debt cycle. He's looking at this $10 trillion event and seeing a systemic deleveraging on the horizon. Mohamed El-Erian says, central banks have lost their omniscience. History provides the warning. But what does this actually mean for your wallet when you wake up tomorrow? Let's get to the bottom line. Let's bring this home. The $10 trillion coupon shock isn't just a headline for Wall Street. It's a direct tax on your future. Think about your 401k. Think about your home equity. Think about your job security. When the maturity wall hits, it filters down to the middle class through a process called consumer wealth decay. As companies bleed cash to pay their 8% coupons, they stop raising wages. Your salary stays flat while the cost of living, driven by that same debt-fueled inflation, continues to rise. The household debt service ratio is already up to 9.8%. That's the highest it's been since the restart of student loan payments and the peak of credit card APRs. You're feeling the coupon shock every time you pay your credit card bill or look at your grocery receipt. The era of easy wealth is over. For the last 15 years, you could throw money at a stock index or a house and watch it grow because interest rates were zero. But in a world where the term premium is back and the 10-year Treasury yields 2% in real terms, you have to actually work for your returns. You have to be smarter. You have to be more defensive. The $10 trillion isn't just disappearing, it's being transferred. It's moving from the balance sheets of the companies you work for and the stocks you own, and into the hands of the shadow lenders and the sovereign debt holders. It's a quiet dying of wealth. It's the sound of the future being sold to pay for the past. And honestly, this is the most important thing you need to understand today. So here's my question for you. If the world's largest pension funds are quietly pulling out of public markets, and the smartest billionaires are hoarding dry powder to buy the wreckage, what are you doing to protect your own wall? The coupon shock isn't coming. It's here, and the bill is finally due. I'm your host, and this has been your morning briefing. Think about that next time you see the markets rallying on good news. The wall is still there, and it's not getting any smaller.